don't know.
I don't know if they can hear us right now.
Normally they start the show with that noise.
All right.
Every week.
Is that what that? It's my first time.
Right.
Sorry, it's my first time, guys.
So welcome, Anthony Smith.
Welcome, Zach Strickland. I'm Anthony Smith. You're Zach Strickland.
Yeah, correct.
And this is Freightonomics.
What do we do at Freightonomics, Anthony?
Freightonomics, we bring freight and economics together. Thing about it, they really intersect really nicely because freight is all about supply and demand, economics all about supply and demand, and really it's a really powerful pairing.
Economics is everything.
And freight is everything.
Everything in your world, at least.
It is in my world, yeah, you're right. I think of opportunity cost with everything I do.
So we got a big show today.
Exactly.
Doing a 30-minute show.
Yes, it's going to be a quick hit. It's going to be
we got a lot of
swift show, if you will.
Oh.
Yeah.
So yes, they had some earnings today. We'll talk about those here in a second. But we also have a few things that are coming up. We've got the freight market that still continues to fall. We'll talk about the volumes, the tender rejection rates, the spot rates in general. But also we're going to talk about some container volumes and what they may or may not be signaling in the market itself. So pretty action-packed show. We got 30 minutes to cover it. Now 27 minutes and 38 seconds.
More like 25.
Yeah, and you've got a few economic releases that we need to tie in as well. So let's get after it.
Let's do it.
Let's do it. Knight-Swift, like I said, the largest for-hire truckload carrier in the United States by revenue itself, size. It is huge, massive, a large amount of trucks and trailers to cover all of your capacity needs in the United States. And they came out with their earnings today. So what exactly is Knight-Swift's mix? We talked about J.B. Hunt last week. J.B. Hunt is not necessarily a huge truckload carrier. I think that might be somewhat news to people. A large amount of their revenue comes from intermodal volumes, and then again, an even larger amount versus truckload comes from dedicated services, which is a truckload service. But dedicated is not the same thing as your for-hire trucking market. It moves outside of the spot market, et cetera. These are, the shipper essentially pays for this freight. Pays for this capacity, whether they use it or not. A true contracted agreement, if you will. Knight-Swift, not that way at all. So they are a 1.2. Let me make sure my numbers are right here. I got them written down right here.
You're a man of numbers.
Yeah. I love numbers. I got it. I'm sorry. So $1.1 billion. $1.1 billion. Now, J.B. Hunt, of course, is $2.2 billion. Mm-hmm. So people might say, wait, J.B. Hunt's bigger. Well, not in the truckload sector. Right. So 75% of that $1.1 billion comes from their truckload sector. So they are much, much larger. They're 8 times the size of J.B. Hunt in terms of for-hire trucking. They're, Knight-Swift itself, they had a big mega merger back in 2016. And now they are, pretty large representative of the overall capacity in the for-hire trucking market. So they had a little bit of a decline in revenue in the first quarter, which, again, I'm not too concerned about here. What I normally like to look at with these earnings, and I'm not worried about analysts and their estimated expectations, et cetera. That's for the financial sector. That's for the stock market analysts, et cetera. These guys do not understand trucking operations. They don't necessarily. They put their projections out based on, financial figures, et cetera. Not heavily involved in the KPIs of the trucking world, the operational metrics. So for me, I'm looking at ORs. I'm looking at operating ratios. Of course, they are too. I'm not negating that they're not looking at those, but I'm looking at these to tell how efficient was their operation this year. Give me some add backs. Give me some, what were the whoopsies? What were the accidental, incomes, et cetera. But overall, it looks like Knight-Swift did pretty well. They did beat estimated, analyst earnings expectations by a good bit on the earnings per share, which of course is what matters to the stockholders. But for me, as I'm looking at this company, they did a pretty good job in the first quarter, as I would have expected.
Really?
Anthony, which may come as a surprise because these guys, again, huge amount of capacity.
Right.
A lot of diversified consumer base. They got a lot of consumer products, a lot of exposure to what we saw in our OTVI, which was a surging amount of volume, tender rejection rates in March. So theoretically speaking, they should have had a pretty solid first quarter because they had, honestly, their March could have theoretically been better than their January, February.
Yeah.
January, February, very slow time of year for trucking. So let's break down the numbers. So year-over-year gross change in truckload sector revenue down about 5.1%, or $44 million, $44.5 million. Not that surprising.
Okay.
And I'll tell you why. Because contracts, if you remember, we talked about CAS last week. The CAS indexes for line haul rates down 6.3% year over year. These guys have a ton of contracted volume. That means that they are going to see a lot of their bids come in starting in January lower than they were this time last year. So all that contracted freight volume is going to have a decreasing pressure on their revenue, et cetera. It's also going to have a declining pressure on their OR if they don't do anything about their expenses. However, they appear to have done something about their expenses because their OR, operating ratio, improved 20 basis points on the truckload side from 86.7 to 86.5%. So their margins actually improved on the for-hire carrier market. Now, this could have been some sort of factor due to the fact that we did see a lot of spot market activity in March.
Yeah.
They could have been out there playing the spot market. We'll talk about the brokerage segment here in a minute. They could have been diverting a lot of resources to their contracted for-hire side, which is the case with a lot of these, asset-based brokerages. You have all the major carriers out there. They have a brokerage segment. Some of them separate that more than others. Now, the Knight Swift segment does appear to operate in conjunction with their asset-based side. So it's not a pure brokerage, to say the least. So, again, they could have been utilizing a lot of that spot market activity, saying, hey, brokers, if you're seeing some better paying freight out there with higher margins, divert that to the asset-based side, and we'll take advantage of that money. Makes sense, right?
Right.
So I'm guessing that happened to an extent, but they definitely did reduce their capacity overall. They reduced their fleet size over the course of a year by about 400-something trucks, and that definitely has a little bit of a sustaining factor on terms of like how much, how their expenses are, declining in relation to the revenue. So the revenue per tractor actually went down 2.7% still as they reduced all that stuff. So again, they managed to decrease their operating expenses with some declining tractor counts, but also they did some other things to make sure that their expenses were down.
Right.
It wasn't simply just reducing their fleet size because their revenue per tractor went down as well. Average length of haul stayed relatively flat, 428 miles per haul versus 429. Pretty long haul in terms of space there. So that's a day run. That's a pretty good average length of haul. If you ask me, they're kind of a regional. They keep a lot of their fleet inside of a certain range.
Right.
So they did a pretty good job there, maintaining the length of haul. As we saw on the Sonar side, we saw average length of haul decline tremendously as a lot of the freight volumes went metro.
Yeah.
What I mean by that is that there was a lot of like Harrisburg to New York City movements. Harrisburg to the megalopolis. You had Los Angeles to Los Angeles freight going haywire because you have a lot of DCs servicing all that consumption. So they did a pretty good job there. Again, you can't deny these numbers. So let's move on to the logistics side. Their logistics side, however, did not fare quite as well. Their OR, now ORs for brokerage is a little different because they have no assets.
Right.
You're talking about how much can I buy a truck for? They don't manage the truck at all.
Right.
They just tell you where it is.
Yeah.
Operating ratio declined from 91.6% to 95.2%. So that just means that their margins compressed. Their average revenue per load went from $14.32 to $13.78. Again, seeing that downward rate pressure year over year because of contracts probably pulling a lot of that down. They could have had some propping up in March due to the elevated spot market activity that could have kept those numbers actually could have been a lot worse.
Yeah.
So their brokerage gross margin went from 17.8% to 14.7%. Again, asset-based brokerages, it's kind of on par with what I would expect. A lot of that revenue probably went over to the asset side, cannibalized a lot of the brokerage side. I want to see Echo's earnings to really tell me what's going on in the brokerage segment for real and tell me what's going on there.
Again, as you're jumping through these numbers, you're, I think, making a really good point of not getting too caught up in one specific area.
No.
You can't get caught up in just the revenue, what's happening with the operation ratios, what's going on with the margins, everything.
Yeah, there's little details in here that are buried here that are hidden if you're not looking at them. you're not going to be able to see the full picture. Their other segment, which again, their second biggest segment, their brokerage is not a huge piece of their business in relation to the other two, but intermodal suffered quite a bit. This might be the most concerning side for me for Knight-Swift looking forward. Intermodal volumes are down roughly 9 to 10% year over year, and they really took a hit in April versus March. And these guys are already showing dramatic contraction on their intermodal side versus this time last year. So the revenue dropped about 10.4%, or I should say 12% overall, from 87 million to 76.8 million. Their margins dropped to about 14.7% from 17.8%. But again, you're talking about, I'm sorry, I was quoting the wrong thing. 115 million on the revenue side for Knight-Swift Intermodal versus 94.6%, or 94.6 million this year. So dramatic, an 18.2% contraction year over year on intermodal volume.
Over 20 million difference.
That is a dramatic fall off. Their OR went from 98 to 102.8. Not making money.
Above 100. So yeah, you're not making money at that point.
Not making money.
Sustainable.
The intermodal, again, intermodal dropped off more dramatically in March than it did in April. So that means that, or more dramatically in April than it did in March. So that means looking forward to Q2, these guys are exposed.
Yeah.
Pretty large, because J.B. Hunt actually did better in their intermodal sector.
Right.
And they are a huge intermodal carrier with their contract with BNSF. So looking forward, that is a little bit more concerning. Their truckload side seems to be doing pretty well. Their brokerage, about on par with what I would think with the asset-best brokerage. So these guys are, overall doing okay, obviously. But that intermodal sector may be a big headwind looking forward.
Yeah, I mean, looking at above 100% operating ratio, I mean, that is...
It's always bad.
Horrific.
It's always bad, especially on the very consistent and stable intermodal.
Yeah.
That means that their rates were not sufficient, and they're not able to keep them up. I mean, you have so much truckload capacity right now at a discount because the market is discounting itself, and if you cannot get your rates above... I mean, intermodal is a very incremental business. You get certain amounts. I mean, their deal with a rail is probably a big headwind here.
Right.
It's just not as good as J.B. Hunt's is, which I don't think is a secret in the industry.
We have another earnings report, don't we?
Yeah. So Heartland's one of my favorites. And these guys, of course, one of the smoothest operators out there. They keep their operating ratios real tight. These guys tend to do really well. They're a $166 million in the first quarter this year. So that's compared to $139.5 million.
So an increase of over 25 million there.
Yeah, we got a big increase here. Now, not so fast. They bought Mills. They bought Mills Transportation out of North Carolina last year. So a lot of that has to do with the fact they did have some additional assets to work with, along with additional customers. Their OR, their adjusted OR, increased from 83 to 88.2. Not a great move, but again, these guys, this is what they do. They'll buy a piece of business. It takes a little bit of time to get everybody in line, get them on the same page, etc. I'm not super concerned about Heartland moving forward. They will adjust. They had to sell off some equipment at a loss. And also Knight-Swift cited this as well. The used truck market has collapsed. Again, a lot of people buying trucks. Last year, oversupplied the market. Not a lot of demand for those used trucks. Collapsed the rate, so they had to take some loss on a couple of units that they totaled. So that had a pretty big impact on their bottom line in the first quarter. But again, an 88 OR, tremendous, tremendous. I think looking forward, you're talking about, if they can sustain anything above, I mean, for me, if they can keep it below a 95 OR in the second quarter, they're killing it.
That's a win.
They're killing it. Again, I think the lesson to learn from both of these earnings reports is the fact that we have not fully recognized the extent of the coronavirus impact in these reports. You cannot apply these first quarter earnings to the second quarter whatsoever. We saw the most dramatic decline in volumes at the end of March, starting in April, intermodal included in that. So capacity itself, spot rates, all had a little bit of an inflationary thing, and that might have actually overcome or buried the fact that a lot of these contracted freight rates took decreases this year. It looks to me like we saw a lot more contracted freight bids being pulled back from 2018 levels, which is going to, of course, show up throughout the year this year because you have an annual bid cycle. That's going to be a big problem for these guys moving forward. And now, on top of that, you've got this dramatic 15 to 20% drop in volumes overall in the market.
Yeah.
It's going to be, the second quarter earnings are going to be eventful, to say the least.
Yeah, I think it's going to be abysmal across the board, not just for the logistics or trucking industry, but we're looking at the overall economy. I mean, just March alone, as you mentioned, late March was different from mid-March, which was different from the beginning of March. It was just a roller coaster of a month. And when we're looking at that across the economy, that's much is the same across the economy. And some businesses are shut, some businesses are still closed. And now we're kind of looking at to what's happening and how that rollout's going to happen, what businesses are going to start to come back online. And when we're looking at that, we have, as most economists have, absolutely no expectations of anything positive being shown in the second quarter GDP numbers, even though we haven't even gotten first quarter GDP numbers.
Right.
So it's everyone's already dreading that second quarter.
I think everybody's been pretty much expecting a rough 2Q.
Yeah.
But I think also since we've been staying at home and doing our, the COVID thing has really impacted our lives in March, we might have been applying too much of that early on in this cycle.
Yeah.
Yeah. So OTVI, the big debate in the freight market right now, have we bottomed out? I don't know.
I'm going to ask Craig.
Yeah, probably not. I would contend no. Some people would say yes, we are approaching a bottom. I hope they're right. It does appear that we are slowly declining our rate of decline. Yeah. OTVI, of course, hitting one of the lowest points and then kind of sticking there. We're seeing about a 2.2% decrease week over week in volumes themselves, which is far better than that 10% week over week decrease or 15% week over week decrease that we saw in previous weeks. So we are slowing the rate of fall. Tender rejection rates hitting that 3.32%, the lowest value ever. That's not going to get better anytime soon in terms of spot market activity. The spot market itself is probably going to just be a desert moving forward. If you don't have a contracted freight rate, I mean, you're just expect to have to live on scraps for a little while. The volumes are going to have to increase to make any. I think Craig even mentioned that in his thing. Volumes have to recover before you see any kind of legitimate spot market activity increase, upward pressure to rates, et cetera, which may not happen for, several months.
Right. And you spoke about volumes. Capacity is still a big thing, right? So we're looking at rejections. Those are near record lows since we've been tracking this.
So right? March 1st, 2018, we created this. And, last year we hit about a 3.78% in August.
Yeah.
Tender rejections. So again, the story of that was oversupply. Volumes were we're recovering at that point to a decent level in terms of our historical perspective, but so many people had added equipment. But you look at these last two earnings reports, actually the last three earnings reports we covered here, every single one of them stated lower tractor counts.
Yeah.
So everybody has pulled back on their tractor counts, at least for their for-hire units. J.B. Hunt increased their dedicated tractor count, which actually may make sense moving forward. We'll see. If shippers have that dedicated volume, I mean, they're locked into those trucks whether they use them or not.
Yeah.
So that may work out in the long run, but we'll see how those contracts play out because they could always go in and say, like, hey, we need to renegotiate. COVID-19 changed the game.
Yeah.
So we'll see how that works out. But we do have a bit of a positive signal.
From what?
But is it?
Is it a false positive?
Is it? So Greg Miller wrote an article.
Brilliant man.
It's great. Read his stuff. American Shipper on FreightWaves.com. He covers a lot of the maritime sector. They all do a fantastic job there. Decades of experience. Greg Miller wrote this interesting piece about how, we're seeing imports increase.
Yeah.
But according to some of the data that he found from Cargo Metrics, that may not be long-lived. So how imports relate to trucking, et cetera. Watch Freight Forecasting tomorrow to find out a little deeper dive on this, but I'm going to touch on it.
Who hosts that?
Michael Vincent. Michael Vincent hosts that.
Is that right? Okay.
He's our forward-looking guy.
Okay.
He's gonna break things down. I may show up. We'll see.
A little teaser.
But the interesting aspect of this is that we watch a lot of these customs on our sonar data. These are counts of shipments coming in from China to North American West Coast, et cetera. We're seeing rates go up as the capacity is controlled on the maritime shipper end. And so volumes, they appear to have gone up over the last several weeks. We're thinking, okay, big time. This is going to be a recovery. Yay, we're going to have volume. Well, imports don't translate immediately to freight volumes. They go into warehouses on the ports, around the ports, into DCs, et cetera. There is some replenishment activity that derives from that, but he's saying in his article that a lot of this volume was happening before people had a chance to cancel their orders for the summer. So we are just now coming into the point where we'll actually start to see a lot of these void sailings, if you will. That's basically where they cancel ships coming from all over the world into the country. We have not recognized that yet, and here over the next month or so, we're seeing the most amount of that happen.
Yeah.
So we have yet to see the bottom on the imports potentially as these volumes start to actually decline. And we're seeing a little bit of flattening in that curve right now.
I mean, when you're looking at this, I think one of the big news items over the last couple of weeks was talking about China and how production's coming back online and how, COVID-19 coronavirus has really been a shock to the supply side of everything. There's also a shock to the demand side of thing, and it doesn't really matter if you are producing and manufacturing's ramping up. If there's no demand for these goods, what does it all mean?
Yeah, exactly. So we were worried about in February, China, no production. We're still buying stuff.
Yeah.
We're going to run out of inventory. Now it's April, and it's like, we're starting to stop buying stuff a little bit.
Yeah, yeah.
I mean, the retailers specifically. I mean, we saw, a huge drop in retail sales in March already, right?
Yeah, very substantial. Yeah, and that was after a suddenly weak February as well. So it was already on a little bit shaky footing already.
I mean, these are not retail-heavy months either.
No.
We see, what are our biggest retail months?
Definitely nowadays we have Christmas in July thanks to Amazon. I'm not sure if that hasn't eclipsed their traditional December holiday months.
Obviously, we have retail season in November, December as the holidays pick up, especially for the freight market. And in June, traditionally, that's where the freight moves for all the retail in summer, as people are pulling in things to get the warehouses stocked up before Amazon Prime Day, before the holiday, before the second most vacation time of year, July, versus Christmas.
Right.
So again, we have a lot of pull forward, and these are the two peaks of the freight market traditionally.
Yeah.
This year, that is in question.
Right, right.
I think we probably saw this year's peak in March.
That's insane to think. And so the other thing I'm really curious about, Zach, we've talked about how we've seen lower equipment sales, lower truck sales, all these things, and really everyone's kind of slowing down activity. Reasonable. Do you think that companies will be able to pivot quick enough when activity starts to pick up? Because it seems like we always see this activity that's always lagged behind what the current market status is. Like when we saw a huge ramp up in 2018-19, everyone started to come online in 2019, but that wasn't the same environment. You're a little too late to the party.
Right.
Now, when we see this a recovery, is it going to be enough proof in the pudding for people to get into the market to say, all right, I'm going to ramp up activity, I'm going to start buying again, I'm going to start getting prepared for increased volumes? Do you think people are going to be late to the party, or really going to be skittish and hold off until they see other things happening?
This is going to be a fascinating thing to watch out. So, or to watch, unfold here.
Yeah.
As we move forward, there's obviously going to be a recovery.
Yeah.
We're not going to last like this, where everybody's eventually going to go back to what they were doing. To what extent they're able to do that is still a huge question mark on the economy, as you would know. To me, this is a difficult thing to forecast, because you're looking at things that, how many of these people are going to be able to go back to work?
Yeah.
They're talking about 70% of restaurants going under.
Yeah.
I mean, that's a huge number. And I know that it's not directly tied to freight, but those people spend money on goods.
Right.
Then there's also the other contingent of people that are not going to go back to work. They're not going to spend money driving downtown to go to their offices, for a while, even as governments start opening back up. It's going to slowly come back online.
Yeah.
These companies and everybody's going to have this lagging impact that we're going to see for the next year.
Yeah.
And we're not going to see these sectors coming online real fast. They're going to come online in sections and pieces, really fragmented, and it's going to have this intermittent glitch. I don't think the answer to your question is no. They will not be able to react fast enough.
Yeah.
Nor will they be able to see it coming with any noted speed, except for the fact if they are watching some information that is near time.
Zach, where could we find such a thing?
I mean, just saying, like there's a little bit of information that we operate on that allows us to see this stuff happening as it's unfolding, given the fact that forecasting models are inherently flawed.
Right.
You do have a chance to at least get early warning signs that things are starting to pick back up in certain areas, et cetera. So, obviously we use our sonar data to track a lot of that stuff. So if you are, even if you do have this information, it takes 2 to 3 weeks to get those orders over from China,
right?
All this other stuff. So it's almost impossible for them to be in front of it unless they already have existing inventory, et cetera. So it is going to be difficult to see.
Right.
I mean, go out there and pre-order your Xbox 480, Nintendo Switch.
Correct. Get your Xbox, get your Switch. You can probably skip out on the Sony. Although Sony does, they make great headphones. I found out.
Sony makes good headphones.
Yeah.
All right.
Yeah. But I think when we're looking at the recovery side of things, one of the things I'm going to be interested to watch on, I know we don't have a lot of time left, but typically when we see government intervention with any kind of hardships within the economy, such as subsidies, it's very difficult to take those things offline. And I know the American people, we need some type of stimulus. We need that bump from the unemployment number. But I'm really interested to see how many individuals are going to be discouraged altogether and really skittish about trying to re-enter the workforce after we kind of get back into a full swing of things. It's like we've extended the unemployment. Some folks are probably making more now on unemployment than they were beforehand, potentially.
That's crazy.
And now if you can ride that wave out, it might be a little bit more advantageous for some to just like, you know what, I'd be incentivized to kind of stay home right now. There's no real need for me to go back to work. So I think that might be
But they're still consumers if they're in that state. So if if that is the case, I'm all right with that from a freight market perspective because they're still putting their orders in on Amazon.
Yeah. My only concern is, Dooner says they're delayed, the Xbox and the PlayStation.
Oh, already.
Sad, I know. That's what he says. Also,
I mean, I'm a Nintendo guy myself.
I have a Switch. And we also have more highs and hellos. I know we're ending soon, but hello to Bartek at TMC. Hello to Steve Perryman. Hello to Razan. Hello to Larry Jones.
Right, Larry.
We have Fassel. Hello. Hope White. Christopher Martinez.
Wow.
Thanks, everyone, for watching.
Thanks for tuning in, guys.
Yeah.
Well, I think we're running up on the end of the show, and I know I'm a Switch guy, and you're an Xbox guy.
Yeah, but I do have a Switch. I've enjoyed the Switch.
Great.
If anyone wants to get served up on Super Smash Brothers or Mario Kart, I'm always here.
Yeah. I mean, what about PlayStation? I mean, it's pretty legitimate.
I don't like the controllers.
All right.
I don't like the controllers. It doesn't feel right. It doesn't feel natty. And Xbox. I can see you guys on Tekken.
I mean, it's a Switch. Switch. Nintendo owns. Let's just say they got the market
It's
share.
family friendly.
Yeah.
It's family friendly.
The biggest audience. All right. Well, that'll do it for our week this week. Thanks for tuning in, guys. Keep in touch.
It's playing us out.